Good afternoon. This is Jim Barlow with OakTree Strategic Leverage, ready to talk about retirement today. I changed the name of this presentation, added some information that might be helpful. Anyway, is there a better way? Don't we all want to find better ways at a lot of things in life? Well, I have a transformative approach to retirement using the inversion wealth framework and Kaizen. Let's get going. I always start with telling you a little bit about me. Um, I'm Jim Barlow. Lived in Clearfield, Utah, virtually all my life. My wife is Barbara. We have 7 children. We have 28 grandchildren. Graduate from BYU. Big fans. Was an investment advisor for 35 years. What are our passions? We love to travel. We visit loved ones. We enjoy family vacations. We read. We attend plays. We treasure time with family. We serve in a temple and strive to be disciples of Jesus Christ. And the reason for my business, I continually want to be doing good and helping others. So, financial strategies. How do I win? That's what people usually think. How do I make a good return? But what if that's the wrong starting point? What if the answer requires a transformative shift on how wealth is built? Now you're saying, what? Well, financial failures don't come from what people see the iceberg. Financial failures come from what they don't see, what they didn't anticipate, they weren't aware of, or they ignored. Most people don't fail because they lack opportunity. They fail because they don't see what destroys outcomes. Loss at the wrong time, emotional decisions, tax drag, poor structure, forced liquidations. Permanent loss compounds faster than growth. That's crazy, but it's permanent loss is terrible. A better question, what would cause me to lose? Then eliminate it. The inversion wealth framework, it's not an investment strategy. It's a transformative framework for building wealth by design. There's really 4 levels to this framework. Inversion. Reverse the situation, eliminate what causes failure, find out what could go wrong. Then, once you have that done, you can build a durable system, a structure to protect you. And if that's all in place, then you can multiply your outcome with leverage. You don't use leverage on an aggressive situation. You do it on something that has some durability. Eliminate what could cause you to fail. And then allow this thing some time. Allow it time to compound. This is probably my formal look at the inversion wealth framework. Inversion, avoid ruin, structure, the system design, leverage, multiplication, patience is where the compounding takes place. Here's another way to look at it. The inversion wealth framework, there's the leaves, there's the branches, there's the trunk, the roots. So the roots are the inversion. Make sure you got it solid under there. Then you can build the structure. Then you have the leverage, the branches, and eventually the outcomes. Remove what kills the tree, build strength, expand growth, results over time. First step, inversion. Avoid ruin first. Identify what destroys wealth. Eliminate irreversible risk, focus on survival before growth. Win by not losing. Oh, I'm sorry. So that was part of my notes on preparing the slide. I'll have to cut that out. Sorry. Step 2, structure. Build a system that works under pressure. Most people rely on markets, timing, behavior. A better approach, design outcomes, define rules, reduce dependency on decisions. Structure carries the outcome, and the right structure creates transformative results, not incremental improvements. Most strategies stop there with those market timing and behavior. Then they try to improve performance. But the real advantage comes next. Step 3, leverage. Use capital more efficiently. Not reckless leverage, structured leverage. Defined entry, controlled exposure, planned exit. More capital working without more risk. Boy. And last, patience. Let time do the heavy lifting. Compounding requires stability. Stability requires structure. Time rewards what survives. Most financial plans are product-based, market-dependent, behavioral sensitive. This framework is structure-based, risk-defined, outcome-driven. Here's the problem. Most people understand these principles, but they don't have a way to implement them. So the real question becomes, is there a structure that does all this? Well, I guess I was going to say yes. It's Kaizen. It's a transformative financial structure that integrates protection, growth, control, and leverage. What is Kaizen? It's a transformative structure that eliminates downside risk, uses institutional leverage, creates tax-efficient income, defines a clear exit strategy. I'll try to give you more detail as we in a bit. How it works? You contribute capital for 5 years, not a lifetime. The bank contributes additional capital alongside you, the leverage. Then the bank continues funding for the next 10 years. I actually should change the wording to the next 5 years. They contribute for 10 years. The policy grows with built-in protection, and then the borrowing that we did, we pay it back around the 15th year. From that point forward, the structure is fully yours, unencumbered, income ready. Why this fits the framework? Inversion, downside protection. It has a zero floor, can't lose. Structure defined system, not market guessing. Leverage approximately 3 to 1, and long-term compounding. What it solves, this is where it gets practical. You can use it for retirement income, wealth transfer, executive benefits. I think I've got 2 slides on this. Oh, well, maybe it's in a bit. Business succession, tax diversification. Traditional approach, save more, invest better, hope markets cooperate. This Kaizen approach is structured for us to eliminate risk, multiply capital by leverage, and let time work for you. One structure, multiple planning outcomes. This is my new slide that one's going to replace. You can use it for retirement income, which we're going to focus on a little bit today. You can use it for family gifting, family protection, creditor protection, tax-efficient income, charitable gifting, employee retention, employee executive retention, business succession, key man. It's just one structure, but you can use it in multiple different ways. And you really don't have to pick one or the other, except for gifting. Oh, seems like my screen froze. Hope that's not the case. All right, here we go. Who's it for? It's not for everyone. It's best fit for high income earners, business owners, professionals, families thinking generationally. The goal is not higher returns. The goal is better structure. And then you're going to have the higher returns. Structure determines outcome more than performance. Why do retirement plans fail? Retirement changes everything. You're no longer accumulating, you're withdrawing. Losses are permanent, not temporary. Sequence risk moves from theatrical to lethal. I'll talk about that more in a second. Timing matters more than average returns. Income depends on the structure, not markets. In retirement, you don't get paid to be patient. It's kind of a different ballgame. The traditional assumptions we're assuming withdrawals are well timed. Taxes stay manageable. Emotions don't interfere. And time is forgiving. That's not necessarily all true at all. Retirement income fails when just one of these areas fail. If any one of them fails, it's not going to work. This is an incremental improvement. It's a transformative shift on how income is created. What happens when stress hits? Markets don't warn you. Life doesn't happen on your schedule. 2020. Everyone remembers this. 34% down February to March. Liquidity froze. Opportunity appears. Layoffs, retirement, health events. 2008. Portfolios down 38% for that year. These are all times I remember as an investment advisor. 2000, -9. 2001, -12. 2002, -22%. I was holding my clients' hands. At these moments, volatility isn't the enemy. Forced action is. The problem is return is timing. Question becomes who has options and who doesn't. Kaizen is designed for the moment. Plans usually fail. This is my transformative structural framework. This is the heart and soul of trying to give you a quick view of all the features of Kaizen. I've listed them in 4 categories. The foundational, the growth, the control, the leverage. Okay, foundation. It's built on a life insurance policy. There's a death benefit. Your family's protected with that death benefit day one. There's living benefits. Disability for injury, disability for sickness. There's long-term care benefits. And then it's tax-free growth and excess. life insurance goes to the beneficiaries, tax-free. Always has since the income tax began in 1913, I believe. Um, and for those who own the policy that is growing tax deferred, you can borrow from it. So you can have tax-free growth and you can pull it out tax-free. There's more to that, but we'll stay at that level for now. And there's some efficiencies. There's no advisory fees. It's not an investment from the investment definition world. There's no management fees. So even though it has life insurance costs, the investment management fees are gone. That's the foundation. Then we have the growth part. Market-linked growth, participation in market gains with zero downside floor. Lost years are eliminated. And when the market starts back up, you start from that higher level, continuous compounding, no recovery years. You didn't lose. They have to do a recovery. How do indexing work? In an index universal life, that's the type of policy we buy. How do they protect the principal? Well, most of the premium goes into high-grade bonds, protection. A small portion is used for index option. So $1,000 excess premium, $950 goes to bonds approximately, grows back to $1,000 in about a year, depending on the interest rate market. And then the 50% we put into options linked to indexes you choose. That's how we get market-like returns with the safety of bonds. Protection first, grow second. The sequencing is what makes the structure transformative. Then we have the control area. Protective ownership. We set this up in a trust system, a master trust, and we set up a trust for every client. That way, they can do the borrowing, the bank management. It's finite funding, 5 years, 5 annual payments, or with all else, you can do monthly payments for 5 years. There's no more payments. It's not allowed per se. Turnkey, you don't need to worry about this because the downside protection is very turnkey. Leave it alone. Flexible liquidity. After you've paid your price of accumulating, the bank putting money in through 10 years, then you have a lot of flexibility. And we put a bunch of riders on this, about 24. It's designed to reinforce and control and protect. Do all the things we want done. We do a lot of it in the riders. So here's a visual on the 5 years. The silver pigs are your personal contribution. 5 years. You can see right below that the bank contributed approximately the same amount in the first 5 years. Then in the second 5 years, you're not paying anymore. They continue to make that payment. Plus, they pick up the payment you were making. And so you get this 3-to-1 leverage. All without the typical risks of borrowing. No credit checks, no loan documents, no personal guarantees, no signature, no collateral. It is not there. And then we do part of this leverage. We use institutional capital, approximately 3-to-1. More capital working day one. Non-recourse, efficient use of capital. And we're going to show you an illustration to show you how it accelerates outcome. life insurance. There is the life insurance, it has a cost, but this structure creates benefits. And even though there's this cost of insurance, which is based on the death benefit of the face amount you're buying, the age of the insured, and the health of the insured, there is this cost. But the real question is, do the benefits of the structure exceed the cost? Can we beat other things even with this life insurance cost drag? That's what we're saying. Insurance chassis allows Kaizen to provide downside protection, tax advantage income, tax-free, death benefit protection, safe leverage, safe liquidity. Ultimately, this isn't about minimizing costs. It's about whether the structure creates a transformative net income. So we have this software, ILIA, in the upper left column, interactive learning information assistant. It's what I use all the time for the people that I work with. And we're going to show you an illustration. And we're going to show you the numbers from the illustration. We're going to do a hypothetical. A 46-year-old person willing to put in $70,000 a year for 5 years. He would like to get a distribution. He wants to get a retirement starting at 65. He wants to guarantee this happens through 90. And we're going to be using a 6.81 growth rate. This is controlled by the NAIC. I won't go into detail on that, but we're going to show the growth of this. Oh, by the way, the reason I chose 46 and 70,000 is that's the average age of all Kaizen buyers nationwide. And the 70,000 is the average contribution by people who buy it nationwide. That's the average. So what we're going to do, we're going to give you some numbers. We're going to show you the beginning distribution for an after-tax investment at the 6.81, a tax-deferred investment. And we're going to show you the Kaizen to show you how these different approaches, same return number, gives different distributions. We're going to add up all those distributions through age 90 to say how much you've taken out for that. Then we're going to talk about how much initial death benefit you had, and also how much you have at age 90. And we can make changes there too. Anyway, let's go through the numbers. So an after-tax investment at 6.81% will pay out for $58,000 a year. And by age 90, you will pull $1,524,000. This is from your $70,000 you put in for 5 years at 6.81. Now, I wanted that $58,000 to be the maximum, the most you can possibly get. So I used every penny through age 90. How much income is at age 91? Nothing. We've used it all. I'm trying to give as high income as possible. Tax deferred, the IRA or 401k, we're $74,000. Is higher, so the tax deferral and delaying taxes works. Now we're going to go to the Kaizen. And as a drum roll, please show me your numbers. Is Kaizen going to be higher than 74, 84, 94? Whatever, it's 130,000. It's over 2 times the after-tax investment. Not quite the two times the tax deferred, but instead of $1.5 million income through 90, you've got $3,380,000 through 90. You had an initial death benefit, which the other two didn't. You have a death benefit age 90, and you could still be taking income. The founders of Kaizen want to do a case study against the worst times in our country for investing on Kaizen or investing in general. So they looked at the 1980s, the high interest rate era, where rates got to be as high as 16.88%. And they also looked at the Great Depression, 30 to 32, where the market went down 9 years in a row versus the market. Not good. So if we do the stress test in the 80s, it goes down to 97,000. All right, it's low. It's gone down, not as high as 130, but as notice it's higher than 74. And notice that's still higher than 58 in the high interest rate market. But those other first two would have gone down too. If we go down the same percent as the Kaizen did, the first one would be at 43, the other would be 55. And you're at the worst scenario, 97. And if we do the same thing, we look at the Great Depression, it had been down to 84,000. That's still higher than 74, but the first two would have been gone down too, to 38 or 48. So if you get it in, lock it in before downturns in your regular market, you're better off. Now, I got another drum roll. What can I possibly do now? Well, Allianz, whatever insurance companies we use, they wanted to study this ILIA illustration software. They wanted to see if these numbers are accurate. And so they did their study and they came back and they said there's an 80% chance. There's an 80% chance that 130,000 is double. 80% chance the 130 is going to be 260,000. So now we see the total range. Maybe the worst scenario, 84,000. Maybe the best, 260,000. Good on the downside, better than others. Super on the upside. Wow. Next, I wanted to look this same guy. What if his average health? See, here I did excellent health. Here I did average health. Instead of 130, Kaizen went down to 120. Still competitive. Now, if you're below average, you might not be able to buy Kaizen. It's really available for probably those who are average or better health. I did one other thing. What if this person's a female instead of a male? Instead of 130,000, it goes to 133. Women are a little bit better risk situation, longer life, so you get more income. Now, the very first policy issued was in 2012. One of the founders and owners of NIW, the founders of Kaizen, and this person since 2012 has added 7.85% per year. Not bad. And the average interest on the borrowed money she's paid is 3.95. So I take the 7.85, subtract 3.95, and you get 3.9. She's made 3.9% on the borrowed money. Wow. Long-term historical returns on the Standard & Poor's 500 is about 10%. Well, it looks like that's better than the 7.85, but remember that's tax advantaged. And if we try to compare that 10% times 75% is 7.5. So finding that additional fish is good for a client. Kaizen principles. Most people focus on outcomes. Wise people focus on how the system is structured, because results rarely fail from lack of effort. They fail from poor design. Inversion, thinking this, asks a better question. What results do I want? not what result you want. What structure produces results consistently? Because system is not an event, it's a system. Structure first, result second. Transformation follows structure. I have a lot of resources for you to learn about Kaizen. Um, we got 2 landing pages. There's a QR code on this one. This one has tons of stuff on it. It has chapters to learn about Kaizen, different categories of information. It has videos, and you don't have to log into something. It's just available to anyone who wants to go to it. That's the first resource. We have a second one, very similar. This one's just like that one, but it's with a special twist. It's for lifetime giving. It's for your grandparents to be giving money to you or your grandkids. Same product, just a little different slant of usage. And last is the, well, not last, third is this ILIA system I've been showing the quotes from. You have to have a login here. So if you want to go with this, you need to have me send, I need to have your cell phone number and your phone number, then I can send you an invitation. Got a lot of links on my, this is my website. My website, I've been working on it just yesterday, made some cool improvements. I'll have to tell about them next week. I've got a wonderful retirement income gap calculator that I built, easy to work with. I've got a more advanced one too, but they're helpful for you. How do you want to get engaged? I showed you that those links that you can go learn about it online. You can probably just stay there online. Ask questions. We'll be having and try to answer, or come see me. Let's go out to dinner. Let's look it over. Same strategy, different engagement styles. The service model. There's us. There's OakTree. There's NIW that founded Kaizen, and they have a service portal. I'm going to add that to this slide. Then we have the institutional partners, the insurance companies. And so even if I'm no longer involved, these institutions behind the strategy continue servicing the structure. Here's our webinars. We're at that number 2, version. I'm going to change the name on this sheet too. Version Thinking, Retirement Income, and Kaizen. Next week, we're going to talk about family gifting. And that's the monthly, the flagship retirement family gifting. Then every other month, we do an employee benefit. And then every other month, business succession. I've done all of those 5. I actually haven't built those last 3. But I've been worrying about getting those 5 and they're up, ready to start running those other ones. Here's the ones coming up. Next Tuesday, the 14th, we have one on gifting. There's the link. You can take a screenshot to be able to go to it. Then the next one, we're going to do a executive employee benefit one on April 22nd. Then April 30th, we're back to the flagship, the general generic one on inversion thinking and Kaizen. And then on May 5th, we'll be going to do a retirement income again, this one. So you can see as we do can redo them over and over again, making changes oftentimes. So most people spend their lives asking, what should I invest in? Better question is, what transformative structure makes success inevitable? Is there a better way? Yes. Start with inversion, build the structure, apply leverage, that time compound. That's the difference. What clients tell me matters most to them. Not what I think, but what do they say matters most? They like the zero downside floor. Can't lose. They like the tax-free access and growth. They like the flexibility in retirement, take money out that where they want without taxes. They like the 5-year funding, and they like having the death benefit, the protection. None of these are about chasing high returns. They're about removing risk, increasing control, and increasing certainty. So after 35 years in the investment business, I've learned to separate products from structures. Most financial tools are products. A few are structural. When someone has a runway and health to qualify, I've yet to see a more efficient long-term structure than Kaizen, because when properly designed, it becomes transformative by nature. So I hope we're getting a little shorter. I hope it's been helpful. If there's questions, send me an email, give me a phone call, text me. Happy to help. There's those 2 QR codes for those 2 landing pages. And that's it for today. For those who are interested, we'll talk about gifting next week. Talk to you later. Bye.